Imagine you are an institutional portfolio manager overseeing $20 billion in assets. At 2:47 a.m., your phone vibrates violently. A trader in London calls with an emergency.
Boss, we have a major problem. Gold futures are in freefall and silver is even worse. This isn't a glitch. The market has completely lost control.
You rush to your desk, and the numbers on the screen instantly sober you up. Gold has collapsed from last night's $5,595 to $4,750, a 15% drop in a single day. Silver is an absolute bloodbath, plunging from $121 to $78, down 35%. But the most terrifying part isn't the drop itself, but the total disappearance of market depth. Normally, the spread when trading gold futures is no more than 50 cents. Now, that spread has widened to $15. All the market makers have fled, and there is absolutely no one catching the falling knife. The trigger for this financial tsunami wasn't war, nor a bank failure, nor even any major economic data. It was two simple English words: Kevin Warsh. On January 30th, 2026, at 10:17 a.m., Trump posted a seemingly routine message on Truth Social. I am pleased to announce the nomination of Kevin Warsh as chairman of the Federal Reserve. I have known Kevin for a long time, and he will undoubtedly be one of the greatest Fed chairs. Over the next 6 hours, global precious metals markets endured the most insane single-day crash in history. Gold tumbled from $5,600 to $4,895, and silver sank from $120 to $83. As that investment manager, you hold more than just a $5 billion position in gold and silver. More critically, your entire investment strategy is built on one assumption: that Trump would appoint a pliable Fed chair, someone willing to print money for political expediency. This assumption had made you a fortune over the past 18 months. Your fund surged 73% in 2025, growing from $8 billion to $14.7 billion. The Wall Street Journal hailed you as a modern-day investment guru, and financial magazines were singing your praises. But the moment that tweet went out on the morning of January 30th, your carefully constructed investment logic completely collapsed. Because Kevin Warsh is absolutely not an obedient pawn. To understand the market's panic, you first have to understand Warsh the man. In 2006, at age 35, Warsh became the youngest governor in Federal Reserve history. It wasn't due to connections, but because he possessed a special skill. He understood both the complex trading games of Wall Street and the policy-making of Washington. During the weekend Lehman Brothers collapsed in 2008, while other Fed officials were debating theory, Warsh was on the trading floors of major investment banks, acting as the translator between the Fed and Wall Street. But what truly left an impression was the dual personality Warsh displayed between 2009 and 2011. On the surface, Warsh never cast a dissenting vote during his 5-year term, appearing to be a compliant team player. But the meeting minutes reveal a completely different reality. In September 2009, with unemployment at 9.5% and worsening, and both Washington and Wall Street crying out for more stimulus, Warsh calmly warned at the Fed meeting, "If policymakers insist on waiting until the economy has clearly returned to normal before withdrawing support, they will almost certainly have waited too long." This statement was spot on, and subsequent inflation completely validated his judgment. Even more telling was in November 2010, when the Fed prepared for a second round of quantitative easing, printing another $600 billion to buy bonds. In a private meeting, Warsh told colleagues directly, "If I were in the chair, I would not push this policy. Frankly, if I were in the majority here, I would vote against it." But ultimately, out of respect for Chairman Bernanke, he voted in favor. This exposes the core of Warsh's character. He defends the team in public, but once he is in power, he will absolutely act according to his own convictions. Bernanke wrote in his memoirs that Warsh had significant reservations about continuing QE. He felt monetary policy had reached its limits, and continuing could trigger inflation and instability, and that other government sectors should shoulder the burden. 3 months later, Warsh resigned. He wasn't fired. He walked away because he no longer wanted to be part of policies he believed were wrong.
By 2025, Warsh's stance seemed to have shifted. He began to publicly support moderate rate cuts, writing in a Wall Street Journal column in November, "Inflation is a choice," criticizing the Fed for being too slow and arguing for cuts. The market began to reassess. Perhaps this former superhawk had truly softened? Perhaps he really would cooperate with Trump to maintain low interest rates? But there is a fatal misconception here. Warsh's change in stance is built on a massive assumption that AI will drive a productivity revolution, fundamentally altering the economic growth model. His logic is this: if AI can significantly boost efficiency, the ceiling for economic growth is raised, inflation pressure naturally eases, and rates can stay lower without sparking runaway prices. It sounds wonderful, but it rests on a gigantic if. Real-world data tells a different story. The Fed's preferred core inflation metric is still at 3.0%, 50% above their 2% target. Even worse, the Producer Price Index accelerated to 3.47% in Q4 2025, deteriorating from 2.97% in Q3. Services inflation, prices most sensitive to monetary policy, stubbornly remains above 3%. Rents, healthcare, and education costs are all rising by over 4%. Where is the productivity dividend from the AI revolution? It is certainly not visible in the inflation data yet. This means Warsh is facing the exact same dilemma he faced in 2009 to 2010. Data showing accumulating inflation risks, while politics demand continued easing. History tells us how he will choose. As he said in 2018, "My greatest worry is the misallocation of resources in the economy and the misallocation of responsibility in government." These problems often hide behind shiny names, staying right under everyone's nose for years, then suddenly erupting at the worst possible time, causing unexpected harm to the economy. The crash on January 30th exposed a much larger problem. The gold market has been paperized to a perilous degree. In your $20 billion gold portfolio, the portion backed by actual physical gold is likely pitifully small. Let's do the math. Global annual gold production is roughly 3,600 tons, worth $700 billion. But the daily trading volume on the London Metal Exchange alone exceeds $300 billion, and New York COMEX gold futures trade another $200 billion daily. That means the daily volume of paper gold trading is more than 70% of the entire year's physical gold production. Even more terrifying is the leverage. Gold futures on the CME require only a 7% margin, allowing for a theoretical leverage of 14 times. In the options market, leverage can exceed 100 times. The whole market is like an inverted pyramid, with massive paper trades built on a tiny physical foundation. When the Warsh nomination news broke, this precise financial machine instantly revealed its cracks. Most shockingly, while New York gold futures plunged, physical gold premiums in Shanghai and Dubai soared to over $20 per ounce. Normally, arbitrage would close this huge gap between paper gold and real gold in minutes, but now it persists. This reveals a terrifying truth. In extreme scenarios, paper gold and physical gold become two completely different assets.
You think you're buying gold, but you might just be buying a promissory note, which could turn into waste paper in a crisis. The deeper issue is that when you buy a gold ETF, you are effectively buying a creditor's claim on a bank's promise to provide gold. But the gap between these banks' physical reserves and their book promises is huge. Industry estimates suggest the ratio could be as high as 100 to 1.
Wall Street's panic is understandable. But looking calmly at the fundamentals, the forces supporting precious metals aren't weakening, they're strengthening. In 2025, global central banks bought 863 tons of gold. While below the record levels of the prior 3 years, it remains far above historical averages. More importantly, the distribution of gold buyers has fundamentally changed. It's no longer just challengers like China and Russia. Even staunch NATO allies like Poland have become major buyers. The Central Bank of Poland bought 102 tons in 2025, bringing gold to 28% of total reserves, nearing their 30% target. Brazil's central bank re-entered the market for the first time in 4 years, buying 43 tons over 3 consecutive months. Kazakhstan bought 26 tons, Uzbekistan 12 tons, and even the conservative Czech central bank has started buying. This isn't speculation, it is a strategic pivot. A 2025 World Gold Council survey showed 73% of central banks expect to reduce USD reserves and increase gold allocation over the next 5 years. 95% of central banks indicated they would increase gold reserves in the next 12 months. The driver isn't fear of Fed policy, but fear of the dollar being weaponized. After the Russia-Ukraine conflict, the US froze Russian central bank assets, sending a clear signal. Holding dollar assets carries the risk of confiscation. Even US allies are wondering if it's wise to put all their eggs in one basket. Warsh's independence might remove the risk of politicized monetary policy, but it can't fix the root cause of de-dollarization, the decline of US hegemony and the rise of a multipolar world. The true historic significance of Warsh's nomination is that it marks the potential end of the US government solving fiscal problems by printing money. The US fiscal deficit for FY 2025 is $1.8 trillion, or 5.9% of GDP, far above the 50-year average of 3.8%. Federal debt to GDP has reached 99.8% and is on the verge of breaking 100%. Even more critical is the cost of debt. Interest payments already consume 3.2% of GDP and are projected to hit 6.3% by 2054, far exceeding the 1991 peak of 3.2%. This means more government revenue must go to debt service rather than infrastructure, education, or defense. Warsh's independence will actually sharpen this problem. If the Fed refuses to print money to buy treasuries, exactly what Warsh opposes, massive financing pressure will shift to the private market. Imagine this. The US Treasury needs to borrow $150 billion a month, but the Fed isn't buying. Who will? Foreign central banks are dumping dollars, domestic banks have capital constraints, and pension funds need to diversify. The result is soaring treasury yields, further worsening the fiscal situation in a vicious cycle. The dollar might benefit briefly from high yields, but this false prosperity cannot mask the fundamental issue. The US fiscal path is unsustainable in peacetime. Based on Warsh's history and the current economy, we see 3 possibilities. Scenario 1. The AI revolution is real. If AI truly triggers a productivity boom, service automation breaks through, and labor productivity jumps from 2% to over 4%, effectively crushing wage inflation, service prices will cool significantly. In this case, Warsh's conditional dovishness is vindicated.
He could cut rates 2 to 3 times while maintaining stability, lowering rates to 2.75% to 3.25%. The 10-year yield could fall to around 3.5%. Gold could return to the $5,000 to $5,200 range, and silver could rebound to $90 to $100. But even in this best-case scenario, de-dollarization and geopolitical risks remain, providing long-term support for metals. Scenario 2. Inflation remains stubborn. This is the most likely outcome. AI effects appear slowly, with limited impact on overall productivity. Core inflation sticks between 2.5% and 3.0%. Service prices rise strongly, and housing prices remain historically high. Faced with this, Warsh's hawkish instincts kick in. He might grudgingly cut rates once or twice under pressure to 3.25% to 3.5%, then firmly hit pause. More importantly, he will start talking about shrinking the balance sheet. Gold would oscillate between $4,600 and $4,900, with silver fluctuating between $80 and $95. The market would shift focus from monetary policy to fiscal and geopolitical risks. Scenario 3. A full hawkish awakening. If core inflation re-accelerates past 3.5%, especially in services, Warsh's Volcker DNA will be fully activated. Just like in 2009 to 2010, he will unhesitatingly prioritize fighting inflation over politics. Warsh would stop cuts and possibly resume hikes, pushing rates to 4.5% or higher. He would also accelerate balance sheet reduction, potentially by $100 billion a month. Gold could fall to $4,100 to $4,300, and silver could crash to $65 to $75. But even here, central bank buying and safe haven demand would likely provide a floor. The trigger is if January inflation stays above 3% for 3 months. The odds of this scenario would spike. As a manager of $20 billion, you face not just volatility, but a rewrite of the investment rulebook. First, rethink your gold allocation. If you are heavy in ETFs or futures, paper tools, January 30th should be a wake-up call. I suggest moving 30 to 40% of gold into physical holdings. While ETFs claim physical backing, ordinary investors cannot redeem them for actual gold. Safer options are buying bars and coins directly or using storage programs like the Royal Canadian Mints. Liquidity is lower, but you truly own the asset. Institutions should consider physical storage in Singapore, Switzerland, or the UAE for stability and property rights. Build an early warning system. Watch core inflation, but monitor the service sector breakdown even more closely. Trends in rent, healthcare, and education are key for policymakers. If core services inflation exceeds 3.5% for 3 months, cut risk sharply. The 10-year TIPS yield is central to gold pricing. History shows gold faces pressure when real yields top 2%. Set 1.9% as a warning line and 2.1% as a retreat point. Track central bank gold buying monthly, analyzing not just volume, but geography. If traditional Western allies like Germany, France, or Canada start buying heavily, it signals the dollar system is loosening faster. Precious metals are just part of the hedge. Consider a broader de-dollarization portfolio. Add some platinum and palladium. They have industrial use and concentrated supply. South Africa, Russia, performing well if supply chains break. German bunds, Swiss bonds, and Singaporean debt offer safe non-dollar options. Yields are low, but they may shine during a dollar crisis. Bitcoin, despite volatility, shares gold's traits: limited supply, decentralized, hard to confiscate. Consider a 1 to 3% allocation as insurance for extremes. De-dollarization creates historic chances for emerging markets. South African mining faces challenges, but its reserves are world-leading, offering potential excess returns in a gold bull market. Kazakhstan and Uzbekistan are major producers pushing de-dollarization. Their resource companies could see dual benefits.
The gold flash crash of January 30th wasn't the end. It was the beginning. It marks the final collapse of the Bretton Woods remnants and the acceleration of a multipolar currency system. Warsh's nomination ends the risk of a politicized Fed, but closes the door on using monetary policy to fix fiscal problems. In a world of independent central banks and indebted governments, the adjustment burden shifts to exchange rates, inflation, or assets. We are moving from a unipolar to a multipolar currency system. Traditional theories will be overturned, with new risks and opportunities emerging together. Gold's role is shifting from a simple inflation hedge to insurance against systemic uncertainty. Prices may be more volatile, but strategic value will rise. Investors who adapt, understanding physical versus financial assets, recognizing geopolitical risk, and preparing for monetary restructuring will win the next decade. Those clinging to old models may find themselves, like holders of British pounds on August 15, 1971, suddenly on the wrong side of history. Remember this moment, and remember the name Kevin Warsh. He may not realize it, but he just triggered one of the most critical turning points in financial history. The real question isn't how high gold goes, but in a world where the US can't dictate policy, where risks rise and tech reshapes economies, what assets preserve value? The answer may lie with those central banks quietly stacking physical gold in global vaults. They know better than any analyst that the real game has only just begun. You hold not just a decision, but a historic bet on the future world order. Choose physical, choose diversity, choose independent thinking. Because these choices could determine your wealth for the next decade. If this analysis made you rethink your strategy, share your thoughts in the comments. Like to support deep financial research and subscribe for exclusive insights on major market turns. Will Warsh be the next Volcker or Greenspan? Tell us your verdict below.